If there's one thing investors generally want from their bonds, it's a little bit of certainty. How much interest they can expect to earn, how much risk they'll take to earn it, and how long they'll need to tie up their money to get it. Well, there's a new type of bond fund that aims to offer that certainty with the simplicity and convenience of the ETF wrapper. Let's find out more about it. You're watching Inside Investing. Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Caitlin Cormier. Joining us is Trevor Cummings from TD Asset Management. Trevor, it's nice to have you back on the program. Thanks so much for coming by.
Hey, it's great to be back, Caitlin. Thanks for having us. Appreciate the opportunity to talk a bit more about ETFs today.
Yes, absolutely. Always a hot topic. Really excited to get further into our conversation. Before we do, just a quick note to our viewers, subscribe to our YouTube channel, TD Direct Investing, so you don't miss a single episode of Inside Investing. Make sure to let us know in the comments what you think about today's episode and what else you'd like us to cover on the show. With that said, let's get into it. First off, Target Maturity Bond ETF is a bit of a mouthful. Can you unpack how these products work at a high level?
Yeah, sure thing, Caitlin. These are ETFs that hold a portfolio of individual bonds. And most importantly, or maybe the key feature to these, is all of the bonds have a very similar maturity date. So if you thought of, say, the 2025 ETF, the investment grade corporate bonds all mature sometime in the year 2025. And so what this means to an investor is that the ETF has the characteristics of the bonds inside, but they all share similar traits. They'd all be investment grade, for example. They all mature in that given year. So you have interest rate sensitivity or duration or term that's going to be very, very similar. Now, a couple interesting things about the ETFs. They do terminate, they end, they mature, if you will, in November of the year in question. And so at the end of that year, the ETF would disappear from a portfolio and cash would be deposited into the investor's account to reflect the maturity value of that investment, like a bond or a GIC. And maybe more interestingly, not every single bond in the ETF matures at the end of that year. So if I buy the 2026 ETF, for example, well, some of the bonds might mature in the first quarter or the second quarter, maybe into spring or summer of that year before the ETF terminates. And so as the portfolio manager, what TD Asset Management is going to do is take those bond proceeds and reinvest them into short-term corporate bonds, such that you're always invested in a portfolio of bonds and you always have that maturity in November of the year in question.
Okay, rolling on with that. So what needs specifically do you think that these target maturity bond ETFs serve for investors that the traditional bond fund might not?
I think one of the advantages to target maturity bond ETFs is predictability. When you buy a bond or a GIC, you have a sort of a sense of what it is that's going to happen. And yet when you buy a traditional bond ETF, for example, or bond fund, whether it's passive or active, there's always turnover inside of the portfolio. Bonds inside of the ETF are always maturing, they're being replaced with new bonds and so on. And so your returns are going to be part and parcel due to changes in interest rates, supply and demand, optimism, pessimism, things like this. And it's difficult to predict so many things and how they would affect your investment at one given time. These target maturity bond ETFs do offer a sense of predictability because you have a maturity value, you have a par value. And you can kind of map out or pencil sketch or back of the envelope determine what it is your return is going to be as an investor. I think the other big benefit or need to these is flexibility. So, kudos to anybody who was investing in, term products a year ago because you were probably getting 5.5, maybe even 6% interest on your investments. But at the same time, those are locked in. Those are locked in for the life of the GIC, for example. And these, on the other hand, trade on the Toronto Stock Exchange. So you have T+1 liquidity. If you want to change strategies or if there's a new opportunity, you can use these ETFs to your advantage and maintain that flexibility.
Okay, very interesting. Almost like a bit of a hybrid product. You've got the some of the features of fixed income and then features of exchange traded funds as well. So, what are some of the potential benefits of holding the target maturity bond ETF rather than something like a traditional bond fund or even individual bonds or GICs?
So if you think of buying an individual bond, you've got one business, one company, one level of credit risk. Hopefully, they're a good credit risk and they're going to make good on their obligations to you. But they also only pay that interest twice per year. Because you're buying an ETF that has maybe 45, 55 bonds in it, there's always bonds in there paying interest at any given time. And so the ETF pays its income, its yield on a monthly basis, which is usually handy. A lot of GICs are compound interest; they don't pay anything until the end. If you hold the ETF to maturity, you have a couple things that are given to you when you make the investment. So if you do your research and you know, okay, today's price is what I'm going to invest at. I also know what the weighted average par value is, and that's an approximation of the maturity value of the ETF when it terminates in November of the year in question. I can also look at the bond portfolio and what the interest coupons are on that portfolio. And again, I can map that out to my exchange traded funds. So if I have 24, 30, 12 months left on that ETF, I know what the monthly distribution is going to be. And maybe lastly, and this is something that's new given what's happened to interest rates over the last few years, tax efficiency. So now that many, not all, but now that most all perhaps bonds are trading below par, some of the investors' return is actually going to be capital gains as those bonds move up in price. And some, of course, will be interest, the coupon, and the interest income would be fully taxable. But if you think of, say, a non-registered or a taxable account, there's actually the potential for increased tax efficiency since some of your total return could be capital gains as well.
What are some specific examples of how target maturity bond ETFs might help an investor reach their savings goals?
Yeah, so the ability to map the outcome is the single biggest advantage to these ETFs. You can think about, say, some future liability. You're closing on a real estate transaction and you need that money. Let's say it's a new build, and so you don't need that money for 18 months. Or you have a tween or a teen at home and they're going to go to college or university in 4 years. It could be something like this, for example, where if you have a specific obligation at a specific date, you can actually do the math and back out, okay, if I need X dollars 4 years into the future, how much do I need to invest in one of these ETFs today such that at maturity, when I take all the income that I've received and the maturity value, I have that X, right? It doesn't have to be so specific. You can use these as holding sort of parking spots for capital. If, you were a snowbird and you had obligations in US dollars, for example, these are available on the US bond market as well. You can buy them in US dollars. And maybe you're just a retiree and you don't have any specific need, but you want income on a regular basis to fund your expenses and fund your lifestyle. These do pay monthly. So even if you just want a regular sort of retirement income, you can think about using these ETFs for your portfolios as well.
Some investors like to create bond ladders using individual bonds so they know exactly when they'll receive the income that they need. Could they do the same with the target maturity bond ETFs?
Yeah, absolutely. Absolutely. I'd say that's probably one of the most popular uses thus far is to ladder these out as opposed to making a specific, termination or end date at which they're going to revisit everything. I think what a lot of investors are doing are dividing their money up and actually purchasing more than one of these to create a ladder. What happens when you have a ladder is that you always have a portion of your investments maturing in any given year. And so that gives you the opportunity to decide on a third or a quarter or a fifth of your fixed income, for example. What am I going to do with this money? Am I going to renew it into, a 4 or 5 year investment? Am I going to put it into some other product like individual bonds or an active bond mutual fund? Something like that. You can reassess when you have a ladder. So if you think about these ETFs, because there's one for each calendar year and because they mature, that gives you the opportunity to say on an annual basis, okay, I've just had this maturity in my account. What is the best course of action? Should I renew it into, the 2028 maturity, for example, or the 2029 or something like that? Or is there another opportunity for my portfolio that says I should maybe change direction?
Let's say an investor wants to hold bonds to help them save money, but they don't know specifically what they're saving for. They don't have like a goal specifically. Could these target maturity bond ETFs still make sense for them?
Yeah, sure, absolutely. If you don't know what you need, if you don't, again, have a specific liability, you could still think about putting a portion of your fixed income allocation into these ETFs and perhaps building a ladder. Things today are pretty interesting in that short-term interest rates are a little higher than longer-term interest rates. That's atypical. It doesn't always last. It's not the norm, I would say. And so if you think about a ladder or a short-term ladder, you can take advantage of that. And if that goes away, if that stops being the case, if we return to normalcy where longer dated bonds have higher returns than shorter dated bonds, the ladder can help take advantage of that. So you can think about continuously rolling the proceeds of your ladder into new ETFs. Again, until something changes and there's some other opportunity for you as an investor.
Interest rates have been top of mind for bond investors lately. Obviously, we've had lots of announcements from the Fed as well as Bank of Canada. How would interest rate changes affect these target maturity bond ETFs?
Yeah, so we can kind of go back to first principles, right? Think of a generic bond, doesn't matter who's issued it. Let's just go with, bond ABC or bond XYZ, and that bond pays 3% interest when the prevailing interest rates are 3%. Well, that bond should trade roughly close to its issue price of $100, and it just hums along. It makes its interest payments and it matures, and then you get your $100 back. You get your principal back. If rates go higher and all of a sudden prevailing or new bonds are paying 4% or 5%, me as an investor holding that 3% bond, I have an investment that doesn't pay as well as new bonds. And so the market will lower the price of my bond investment. If interest rates go higher, bond prices fall, existing bonds, right? And the reverse is also true. So if I have a bond paying 3% interest, prevailing interest rate is 3%, all bonds are being issued at 3%. And then the central bank, the Bank of Canada, cuts rates, and now new bonds are only paying 1%, then I have a pretty coveted asset. People could go and buy those bonds paying 1%, but if I'm willing to sell them my bond paying 3%, they will pay me extra for that. And so that's sort of first principles, is you have this inverse relationship between interest rates and bond prices. So many of these ETFs should rise in value before maturity, or they should accelerate their move towards that par value. Now, the good thing about this, again, is if it's in a tax sheltered account, a registered account or a TFSA or something like that, it doesn't really matter. It's nice to see the price go up. But if this is in a taxable account, if this is in a non-registered account, then that increase in price is capital gains. And so that's a really nice place to be. Nobody says that you have to hold these things to maturity, right? So if it should be that you have this dramatic increase in price of that ETF, and maybe now it's trading at its maturity value, Maybe you wait and continue to clip the coupon. Maybe you sell early and maybe you move into a different target maturity bond ETF as well.
In your opinion, would now be a particularly opportune time for investors to consider these target maturity bond funds?
Duration is kind of a measure of interest rate sensitivity, right? And the old rule of thumb is for a 1% rise in interest rates, because increasing interest rates are bad for bond investors. So for a 1% rise in interest rates, your fixed income investment will fall in percent by its duration, right? So let's give an example. If I have a 7-year duration on a bond index ETF and interest rates go up 1%, I should expect a roughly 7% decline in the value of my bond index ETF. For a 1% decrease in interest rates, I would expect roughly a 7% increase in the price of that bond index ETF if the duration were 7. So it's not a perfect model, but it's a really, really useful rule of thumb. I mean, nobody can predict the future. I can't sort of suggest that myself or anyone can time the market, to be fair. But generally speaking, the old adages of it's always darkest before the dawn and things like this. And, the consensus view is that interest rates will continue to fall. The market is forward looking, so it's going to bake or assume some of that is already in the future. But if that should come about, then yes, this would be an interesting and opportune time to consider fixed income in general, and maybe these new target maturity bond ETFs specifically or particularly.
Income is also generally important to bond investors. So, how might a target maturity bond ETF's distribution change as the managers of the fund buy and sell bonds within the portfolio?
So I think it's difficult to quantify. The big driver to changes in price and therefore yield is going to be central bank interest rates, but there's also small levers as well, like supply and demand, market conditions or outlook, optimism, pessimism, or fear and greed, if we want to call it that way. There's a bunch of moving parts here. But again, the beauty to all of this is if I buy one of these, I know what my outcome is going to be, and then something happens that I don't expect, that the market doesn't expect, I can simply hold to maturity and I'm going to earn that rate of return that I calculated when I made the investment in the first place.
In your opinion, how might a target date maturity bond ETF fit into an investor's profile alongside other investment products and exposures?
There's this concept out there called the bond triangle. Each sort of corner of the triangle, you can put a couple of initials. So ST stands for stability. As investors in fixed income, sometimes what we want is just something that helps with the stability of our overall portfolio. The Y in the bond triangle is yield. Sometimes I need income from my portfolio, and so I'm going to invest in bonds or fixed income securities that give me more allocation or more offerings of yield. And then RO stands for risk offset. And that corner of the triangle is maybe what I'm looking for is portfolio insurance. I want something to go up in value if the other portion of my portfolio, the portion in, equities, for example, is going down. There are certain asset classes within fixed income that kind of lend themselves to each of these points. And there are pros and cons. There are advantages and disadvantages to each of these points. Stability is the neither first nor worst. You're never the hero, but you're never the zero kind of area of fixed income. And so in here, I would say it's usually sort of that 3-year duration, 1 to 5 year investment grade corporate bonds, where they're never going to save you. They're never going to make a ton of money if there's fear and panic in the streets. But they're also never going to hurt you. They're never going to destroy you if interest rates go up dramatically, like we've seen in the last 2, 3 years. And so stability is another important part of the bond triangle as well. To sum it up, I think if you were to plot the target maturity bond ETFs on the bond triangle, they'd be closest to the stability portion of the triangle. but they're nowhere near the tip or the very edge of that triangle. You're not buying a target maturity bond ETF at the expense of yield, because again, you can look at these things and decide if that yield is sufficient for you as an investor. You will get a little bit of risk offset with these, but the duration, again, the duration on these would be 1 to perhaps 3 years right now. And so you're not going to get as much of the risk offset as you would with long-term government bonds, but you'll get a little bit of that when it's all said and done.
Very cool. I've never heard of that bond triangle before. I like that. I thought I was getting rickrolled for a minute there when you were saying that they're never going to like over with the stability
Yeah,
piece. You were that
never
Rick
going to give
Astley
you
was
up.
jumping into my head.
Yeah.
But no, that's very, very interesting though. That's seeing that visual makes a lot of sense. Like as you kind of drift towards one corner. A quick note to our audience, if you want to learn more about how bonds work and how to pick a bond fund, check out our past episode, The Fixed Income Decision Tree, to help research bond funds. It's available in the Learning Center on Webroker and on TD's YouTube page. Okay, we talked about some of the potential benefits of the target maturity bond ETFs, but what would you say are some of the potential downsides or risks to holding them?
So these ETFs are very, very useful for the portion of your portfolio that needs corporate bonds, but you might also still need some exotic or high yield bonds. You might also need some government bonds in the portfolio, depending on your investment objectives. So these are to a theme, that theme being investment grade corporate bonds. They're not going to be as diversified as a corporate bond index ETF. A corporate bond index ETF might have hundreds and hundreds of bonds inside of it. We might have 50, maybe 60 bonds inside each of our ETFs. But again, if we've done our research, our due diligence as a manufacturer, that should hopefully be a non-issue. And lastly, think about interest rate changes. I keep talking about interest rates falling being a nice tailwind. Nobody knows the future, right? We've had a couple of false starts over the last 2 years where the market thought rates were going to fall and then they didn't, or we thought rates were going to fall and then they went up instead, right? These things can happen. And if interest rates move unfavorably, and you were to sell your investment, you might not actually make the return that you mapped out when you bought the investment, when you bought the ETF in the first place.
Management fees, you talked a little bit about how this is a bit more passively managed active at the beginning, but then more passive throughout the life. How do the management fees for the target maturity bond ETFs generally compare to other, I would say, actively and passively managed bond ETFs?
So if I think about the passive ETFs that exist, they're usually priced at, 0.1 to maybe 0.2% management fees. You can probably get maybe 0.07 or something like that if you looked hard enough for passive fixed income ETFs. If I look at active ETFs, they're often priced at 0.35, 0.45, 0.65, depending on how active and depending on what part of the bond market you're investing in. So the MER on these ETFs should fall at roughly 0.22%. We think that's right in line between the spectrum of, all the way passive ETFs to all the way active ETFs.
Okay, thanks for filling us in on how target maturity bond ETFs work, Trevor. Now, let's take a moment to show our viewers how to screen for them in Webroker to get their research started. Okay, in order to find these funds, I'm going to click on Research. I'm going to go under Tools and click Screeners. And we're going to create an ETF screener in order to find these particular funds. We're going to create a custom screen. We're going to start out by choosing Canadian funds only. Next, we're going to go ahead and select Fund Category and add criteria. When I'm here, I'm going to scroll through and find Canadian Short-Term Fixed Income. So scroll through till I find that. I'm going to deselect mutual funds from the results because I only want to see ETFs. And then I'm going to select index, add to criteria, and we're not going to show index funds just to narrow down a little further. Once we get to the results, I do need to scroll through because remember, I am looking for those target date type of bond funds. So I can scroll through a little bit here. And here you can see at the end some of these, the TD target date, as well as some other institutions as well. So this is where I can find out more about these particular ETFs. I can go ahead and select the ETF fund code, the ticker. Once I get here, I can see some history on this particular fund. I can see a summary of the fund. I can add it to a watch list if I'd like to keep a closer eye on it. I can also go ahead and select a few different of these target funds and click the compare button to be able to compare them side by side, see how their performance is, what they're invested in, all that sort of information side by side here. They are relatively new funds, so there isn't a whole lot of information. However, whatever is there, I'm able to compare side by side. All right, we're going to have to leave it there, Trevor. Any final thoughts you'd like to share with our viewers?
These ETFs are a great opportunity, a great way to get that stability portion of the bond triangle. And that bond triangle is a great rule of thumb for thinking about fixed income within your own account. Do you want stability? Do you want yield? Do you want risk offset? And once you know what it is you're looking for, that can help you shortlist the bonds, the bond funds, the bond ETFs that might make sense for portfolios. If you have any questions or you need any metrics that I've touched on, all of the duration and the par values and things like that, please visit our website, td.com/ETFs.
All right, excellent. Thanks again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on-demand content available in the Learning Center and on our YouTube page. See you all next time.
Have more questions? Check out the links to the right and in the description below.